Hello guys, good day. Welcome to another video lecture in ACC 311 Income Taxation. In this particular video lecture, we will be discussing other ways to compute for the income tax due of a corporate taxpayer. It's income tax due using minimum corporate income tax or tax due coming from gross income tax. Okay, let's start with MCIT or the minimum corporate income tax. Corporations are subject to a minimum corporate income tax, which is 2% based on gross income. As a minimum tax, the MCIT is payable when the corporation has zero or negative taxable income. So obviously guys, when the corporation is using the regular corporate income tax, and if its taxable income is zero or negative, that's of course equivalent to zero tax due. So if that's the case, then therefore MCIT will be applied. Another, MCIT can only be applied when your MCIT is greater than your regular corporate income tax or RCIT. So that means when a corporation opted to use MCIT, then therefore, as the tax accountant of the corporation, we need to prepare two computations. One computation for our regular corporate income tax and the other for our minimum corporate income tax in order for us to ascertain which is which that will be used as our tax due, because tax due again will be greater than between the two, either MCIT or our regular corporate income tax. Now, MCIT is only imposed beginning on the fourth taxable year immediately following the year in which such corporation commenced its operations. So that means not at all times MCIT can be applied to compute for the income tax due of a corporation. MCIT will only be imposed again immediately at the start of its fourth year of operation. So that means there is a 3-year period na the corporation is not allowed to use the MCIT. So for example, the corporation commenced its business operation on 2015. So therefore, MCIT can only be used after 3 years. So that means on 15, 16, 17, on the 2018 year lang magamit ang ating imposition of minimum corporate income tax. As mentioned earlier, guys, minimum corporate income tax is equal to 2% of your gross income. If you're domestic, if your corporation is classified as a domestic corporation, then therefore our tax base will also be the gross income within and without the Philippines if our taxpayer is a domestic corporation. But if the corporation is considered as resident foreign corporation, then it will only be taxable to 2% of its gross income only on its income within the Philippines. And also, if our taxpayer is a non-resident foreign corporation, MCIT is not applicable for this type of corporation. Kapag non-resident foreign corporation, MCIT cannot be used by NRFC types of corporation. Okay? Now, we have here the format of computation for the tax due of a corporate taxpayer if ever the corporate taxpayer has already operated for more than 3 years. So again, we need to compute for the tax due using the regular corporate income tax of 30%, and we need also to compute for the MCIT because the tax due again is the higher between MCIT or your RCIT. So we don't have any problems with the computation of our regular corporate income tax, guys, because this is the exact way of computation that we had in our previous video lecture in computing for the taxable income of a corporation. Okay? We just simply compute our total gross income and deduct all your deductions, may it be itemized or optional standard deduction, to compute for the taxable income and then multiply it by 30%. Okay? After computing for your regular corporate income tax, we need also to compute for our minimum corporate income tax for us to compare whichever is higher. And again, guys, gross income is, for the purposes of discussion in minimum corporate income tax, gross income will be equal to the total gross income from business plus all other non-operating income as long as it is not subject to passive income. Okay? So, whichever is higher, RCIT versus MCIT, then that will be the tax due which the corporation requires to pay. We have here an illustration. Let us say a corporate taxpayer operated on its fifth year of operation has the following data. So obviously, the taxpayer is already operating for its fifth year. So that means MCIT can now be applied in this type of corporation. It has a gross sale of 15 million, total tax adjustments of 640,50,000, 450,000 respectively, cost of goods sold of 6,750,000, deductions of 3,375,000. We also have here interest income from bank deposits, guys, of 20,000 and rental income from vacant premises of 60. So needless to say, this 20,000 is a passive income which is subject to 20% final tax, and this rental income, guys, will be considered as other income. Compute for the regular corporate income tax or RCIT. Compute also for the minimum corporate income tax or MCIT and the tax due. So obviously again, tax due is higher between RCIT and MCIT. So again here, we have the computation for our regular corporate income tax. The usual computation of our regular corporate income tax using 30% corporate tax rate. So we have here from your gross sales minus your total sales adjustments of 1,050,000, that's from 600 and 450,000. So that gives us net sales of 13,950,000 less cost of goods sold, the 6,750,000. So it gives us a total gross income from operations of 7.2 million. Add our taxable income, other taxable income, which is not subject to final tax. So in that case, we have rental income of 60,000. So therefore, we have a total gross income of 7,260,000. Less deductions, guys, of 3,375,000. So therefore, your total taxable income will be 3,885,000. Multiply it by the 30% corporate tax rate. Therefore, your regular corporate income tax is 1,165,500. Okay, under RCIT, your corporate tax will be 1,165,500. Again, we used the itemized deduction here because the problem did not stipulate for an option for OSD. So we used for the itemized deduction. But again, guys, if the problem opted to use OSD, then therefore we will also use OSD in computing for our taxable income. So therefore, again, we have an RCIT of 1,165,500. Another, before we could determine the total tax due of the corporation, we need to compute first our MCIT. So MCIT is your gross income times 2%. So the total gross income here, guys, is 7,260,000. So that is also the exact gross income we computed earlier of 7,260,000. This is also the exact 7,260,000 that we will be using in computing for our total gross income here in MCIT. So 7,260,000 times 2% to compute for our MCIT. So that means our MCIT will be 145,200. So in this case, we can now compare which is which, no? How much that the corporation can pay as a tax due. So we have RCIT value of 1,165,500 and our MCIT of 145,200. So obviously, the amount that will be paid by the corporation will be 1,165,500. So the tax due will be 1,165,000, which is again higher than your minimum corporate income tax of 145,200. Now let's proceed with excess of MCIT. What if, guys, the What if there is an excess of MCIT over your RCIT? So obviously, again, general rule, if your MCIT is greater than your RCIT, then that means your tax due is from your MCIT. Okay? But what will be the effect? What will be the tax implication of that excess of your MCIT over your RCIT? Now, any excess of MCIT over the normal tax of a year shall be carried forward and credited against the normal tax for the three immediate succeeding taxable years. So that means, guys, if your tax due is from MCIT, any excess of your MCIT over your RCIT can be used as a tax credit for the next 3 years only if your tax due from that 3 years is coming from RCIT. Okay? That means you cannot use as tax credit the excess of MCIT for a current year if ever in the next succeeding years your tax due will still come from your MCIT. Okay? But the good thing is that you could accumulate your MCIT. Okay? You could accumulate your excess MCIT and use it as a tax credit when the time comes that your tax due will be coming from your RCIT. But again, take note, you can only use your excess MCIT as tax credit for 3 immediate succeeding taxable years. Meaning, if you weren't able to use as tax credit any excess of MCIT after 3 years, you will no longer have the chance to use that as a tax credit. Okay? So for example, we have here for year 4, year 5, 6, and 7. So obviously, we will start at year 4 because years 1, 2, and 3 is not yet eligible to use or to apply your MCIT. So it's in the beginning of the fourth year pa lang, we could use the MCIT. So let's have an example on year 4. Let us say your MCIT, guys, is 200,000 and your RCIT is 100. Obviously, your tax due will be 200,000, whichever is higher between your MCIT and RCIT. So that means your tax payable, guys, is 200,000, assuming the entity don't have any tax credits at all. So assuming the tax due is 200,000 and at the same time the tax payable is also 200,000. Because again, MCIT is higher than your RCIT. But in this case, on year 4, you have an excess of MCIT over your RCIT of 100. You have MCIT of 200 and your RCIT is 100. That means there is an excess of MCIT over your RCIT of 100. Again, based on the concept presented earlier, that this excess MCIT can be used as tax credit for year 5, 6, and 7 if and only if ang tax due for year 5, 6, and 7 is coming from RCIT. Okay? RCIT. Kung hindi RCIT, then therefore, dili, you cannot use this excess MCIT of 100,000 as tax credit. Okay? Sige, let's continue our illustration on year 5. What if your MCIT is 400 and your RCIT is 200? That means your tax payable is still coming from 400. Okay? Your tax payable is still coming from MCIT. Therefore, the 100,000 excess MCIT over your RCIT for year 4 will not be used as tax credit for your year 5. Okay? For your year 5, you will still pay a total of 400,000 without any tax credit from your excess of MCIT from year 4 because again, your taxable or your tax payable of 400,000 is coming from MCIT. But again, the good thing is you could accumulate your excess of MCIT. So you have 100,000 from year 4 and then you have additional excess of MCIT of 200,000 for year 5. So therefore, for year 5, you will now have a total of excess MCIT for 300,000. Okay? You will use that 300,000. You can use that 300,000 for the next coming years. Pero take note guys, si 100,000, meron na lang siyang 2 more years left. Okay? Because 3 years lang ang prescription period. Si year 4 na 100,000 excess MCIT, meron na lang siyang 2 years. That means kung dili pa siya magamit for the next 2 years, this 100,000 will be watered. Okay? It will no longer be used as tax credit. Pero si 200, it still have 3 years. Okay? Now, let's continue our illustration on year 6. On year 6, we have an MCIT of 100. We also have the value of our regular corporate income tax of 300,000. So that means your tax due, guys, is how much? Your tax due is 300,000. And that 300,000 is coming from RCIT. So that means we can now perfectly use our excess of MCIT with a total of 300,000 since our tax due for year 6 is from RCIT. Okay? That makes our total tax payable for year 6 of 0. Okay? Your tax payable for year 6 will be 0. Sir, what if your RCIT for year 6 is only 200? Okay. What if your RCIT is just 200? So still, your tax payable will be coming from your RCIT of 200,000. But question, how are we going to apply our excess of MCIT? Now, we will apply excess of MCIT on a first in, first out basis or first FIFO basis. Meaning we will exhaust first year 4 and then followed by the remaining 100,000 to be exhausted from year 5. So that means we still have a remaining 100,000 na excess MCIT that is from year 5. Okay? If ever we cannot fully exhaust our total MCIT, then we use and we apply it on a first in, first out basis. Okay? Continuing the illustration, let us say on year 7, we have an MCIT of 100 and an RCIT of 200,000. So in this case, guys, we no longer have a balance of our excess MCIT. So that means our total tax due is 200,000 and at the same time, our tax payable will also be 200,000 because we no longer have balance of excess MCIT that we could credit sa ato ang tax due. And on year 7, needless to say, wala din tayong excess MCIT since our tax due is from RCIT of 200,000. Okay? That should be very clear that the use of MCIT is again based on gross income and then any excess of MCIT over your regular corporate income tax can be credited forward for the next 3 immediate succeeding years. Now, we have relief from MCIT. It's the Secretary of Finance who has the power to suspend the imposition of MCIT. They can suspend the imposition of MCIT when a corporation suffers losses on account of 3 possible scenarios. First, prolonged labor disputes, force majeure, or legitimate business reverses. So that means they cannot employ MCIT. So in cases where there is zero taxable income or negative taxable income, and then these 3 scenarios are present, then the government cannot really enforce this corporation to pay tax due with again the consideration of the Secretary of Finance. We also have here the list of entities which are exempted from MCIT. Number 1, we have resident foreign corporation engaged in international careers. Again, guys, those corporations which are taxed at 2.5% on their gross Philippine billings are not subject to MCIT also. Those RFC engage in offshore banking units, those regional operating headquarters which are subjected to 10% on their Philippine taxable income are not also subject to MCIT. Yung firms under special income tax regime, those under PEZA. So again, when we talk about under special tax regime, guys, they are taxed below 30%. Okay? Example of those is yung registered under PEZA. Okay? meaning they are taxable on a lower tax rate. For example, PEZA, they are taxable using 15% preferential tax rate. So they are not also allowed to use MCIT. Also, proprietary non-profit educational institution and non-profit hospitals, again, based on our discussion, these are institutions which are subject to 10% or 30% if ever they have met the conditions to be taxed at 10%. And then depository banks under foreign currency deposit system. Again, as a sort of recap, these are subjected to um, if we have interest income over these banks, we will be subjected to 50% final income. Pero these depository banks, guys, if they earn interest income, these are subject to 10% final tax, no? If we could revisit our tax rates in corporation. Another is real estate investment trust and non-resident foreign corporation. So again, non-resident foreign corporation is also exempted from using MCIT. So that means they are not applied. They cannot impose MCIT over non-resident foreign corporations. Okay. Now, at this point, let's proceed with another way of computing tax due for a corporation. This is gross income tax. Okay, but take note, guys, the gross income tax is just an optional way of computing tax due. It is the option of the taxpayer whether they opt to use the gross income tax. Okay? The President, upon the recommendation of the Secretary of Finance, may effective January 1, 2020. Okay, sorry guys, this should not be 2020 but January 1, 2000, okay? I'd like to make it clear ha, January 1, 2000, not 2020. Effective January 1, 2000, not 2020. Allow domestic corporation the option to be taxed at 15% of gross income after the conditions have met. Also, I'd like to highlight that the taxpayers that can use GIT is only those domestic corporation. Okay? Needless to say, your RFC and NRFC are not allowed to use domestic corporation. Okay, let's proceed with the conditions required to be met by these domestic corporations in order for them to avail of the 15% gross income. Okay? 15% of gross income will be taxed over domestic corporations if the ratio of the cost of goods sold towards its gross sales or gross receipts does not exceed 55%. And the following conditions are met. So that means if the cost of goods sold is 55,000 and below, because the phrase states that exceeding 55%. So 55 and below, then that means we could avail 15% gross income tax with meeting the following conditions. These four conditions. Example, tax effort ratio of 20%, GNP, ratio of 40% of income tax collection of the total tax revenues, VAT effort of 4% of GNP, and 0.9% ratio of CPSFP to GNP. But usually, guys, what is to be presented in the problem it's the test of your ratio of your cost of goods sold over your gross sales. So the common computation that we will have in the most problems is ito lang 55%, no? So assumption in the problem na these conditions are met already. So example, we have here Right Corporation, a domestic merchandising corporation, opts to be taxed under the gross income taxation for taxable year 2019. Compute for the gross income and gross income tax if its financial records show the following. It has gross sales of 15 million, cost of goods sold of 6,750,000, and deductions of 3,375,000. Take note, guys, that this is particular on merchandising and manufacturing concerns of entities. Because later on, we will have separate computation. What if the corporation is into service industry? Okay? Under merchandising and manufacturing, we are allowed to deduct cost of goods sold to compute for the gross income. Okay? But before going that, guys, let us have the ratio first of our cost of goods sold over our gross sales. We have cost of goods sold of 6,750,000 over our gross sales of 15 million. So that means the ratio is 45%. So since your ratio of cost of goods sold over your total gross sales does not exceed 55%, then that means we are allowed to use 15%. Right? Corporation is allowed to use 15%. And again, your gross income tax from the term itself, gross income, it will be based on gross income. Okay? Gross income. But for merchandising and manufacturing purposes, for the purposes of computing gross income, in merchandising and manufacturing, gross income will be gross sales minus any sales adjustments minus cost of goods sold. Okay, to compute for your gross income. Again, gross sales minus sales returns and allowances, sales discounts if there's any, and less cost of goods sold to compute for your gross income. So we have a gross income of 8,250,000. So that means your gross income tax will be 1,237,500. Tax due of right corporation if ever the corporation opted to use gross income tax. Okay? Now, let's proceed. What if, okay, this time, forgive me on not editing this, guys. This should be illustration for industry. Okay? Service industry, massage services. This should not be merchandising and manufacturing. This should be for service industry. As what I've said earlier, we will have separate way of computing for our gross income because for purposes of computing our gross income for gross income under service industry, guys, your cost of service, okay, your cost of service will not be deducted towards your gross receipts to compute for your gross income. Okay, so that means your gross income will simply be coming from your gross receipts minus gro- um any any deductions or any adjustments like your sales returns and allowances and your sales discount. So if ever meron tayong sales discount and sales returns, so that's the only item which will be deducted to our gross receipts to compute for our gross income. Again and again, your cost of services will no longer be deducted to compute for your gross income if the entity is engage into service industry. Okay? Sige. Continuing the illustration, we have gross receipts of 11,200,000, cost of services for 4,450,000, and deductions of 2,650,000. So let's test first the ratio of our total cost of services over our over gross receipts. So we have 4,450,000 versus 11.2 million. So that means we have 44.20% ratio. So this 44.20% ratio passed the threshold of 55%. Then therefore, we are allowed to use gross income tax. And again here, guys, automatic, since we don't have any gross receipts adjustments, we don't have an item referring to our sales returns and allowances and sales discounts. So therefore, automatic, your gross income will be equal to your gross receipts of 11.2 million. So in this case, we'll have gross income of 11.2 million, multiply it by 15%. So therefore, your gross income tax due will be 1,680,000. Okay, 1,680,000. Okay, I think that's the end of our video lecture discussing other ways to compute for the tax due of a corporate taxpayer. Again, as a recap, aside from the 30% regular corporate income tax, using 30% based on the taxable income of a corporation, we could also compute other ways to compute. We also have other ways in computing tax due, just like MCIT and gross income. tax. MCIT can only be applied or imposed to a corporation, domestic corporation, and resident foreign corporation if these corporations are already operating for more than 3 years, or immediately on the fourth year of operation, your MCIT will be imposed. And lastly, guys, if on the option of the taxpayer, they could also opt to use gross income tax if and only if, again, they have met the required conditions for them to use the 15% gross income tax. So again, that's the end of our video lecture pertaining to MCIT and gross income tax. If you have any more questions or clarifications on the matter, you may comment down it below or you may ask it during our video lecture. Thank you and keep safe, everyone. God bless.